Yeah, let's hit a few more. Vacancy. Obviously, your number is much higher the less doors you have. So you guys have had property managers before on your properties. How's your vacancy been? And has it been only for single family or, you know, duplex, fourplex? I don't know if you guys dealt in that realm before.
Well, I've listened to one particular single family investor, and his rule of thumb or motto is that the fewer units you have in a property, the longer someone will stay there. And I'm assuming that's because his theory is that it just feels more like your home. If it's a duplex or a single family, it feels like your home versus if it's an apartment building, maybe it's more of a transient situation or that type of thing. Um, that said, with I've got a single family home right now. I think the tenant's been there for like 3 years, and her lease is going to run for another year, year and a half from where we are now. So pretty long there. I'm working on an apartment deal right now where people are routinely on a 6 month lease though, because it just turns over a little bit faster. So I don't know, his theory there is holding true for my deals.
Maybe you should do Airbnb in that one.
Yeah. I don't think it's that kind of neighborhood.
There's always something to see in every neighborhood. That's what you can market that as a culture benefit in the ad. Experience a real city urban life. Yeah, I've actually heard that too. And I would somewhat agree. I mean, I've never had single family. It's always been duplex, fourplex stuff on the residential multifamily side. But I could sense that the residents would prefer not having tenants all around them, 360, especially for noise, privacy, things like that. So having half a home is definitely better than being in a bigger complex. Um,
I think it depends too, though, on who's your customer. Like at
right,
least,
that's true too.
I mean, I think at least for like the younger generations that don't have kids or still graduating or figuring out life, I'm hearing they want to live like more in a transient area that's with a lot more bars nearby because it's more accessible or closer to work.
Oh yeah.
You know, I mean,
No, no, you're right. Just even playing on the other side, we're maybe talking about a family too, right? That's in the right school district. They don't want to take their kids out, so they're going to be there for a multiple number of years. Maybe they like the neighborhood. They're older, so they don't have to. They don't have kids even. But yeah, I've been hearing a lot about the sharing economy, the millennials wanting to be in a social area where they can have regular social gatherings, whether it's a recreational area, a pool, a game room type place. They they want to be around people that share the same interests. And with housing prices getting so high, that it kind of forces them into apartment communities or rental areas versus obviously the American dream, because you have to have a substantial amount for down payment nowadays. So it's definitely a good point, and it definitely depends on demographics.
Sure.
So for scalability, you guys have had management. I do my own management and have management take care of properties too. Tell me a little bit more on your experience on maybe the rates, how much involvement you had on managers for your size properties.
So for at least the rates that I'm seeing right now for single families, if you don't have a lot of units, the standard rate that I've experienced is like 10% property management fee. For the property management that I've been using, it's been pretty passive. So it was basically an agreement between my LLC and the property management that if there's any rehab above $250, then they have to notify me to get my approval. So I'm not bothered about the small off-tick items that don't really matter. Um, I've had instances where they might charge for things and you might think it's questionable, so then I have to go ask them for proof of why they're, making these payments to things I didn't know about. So it's good to like at least verify with them.
Like free dinners.
Oh, they definitely didn't call it that. I mean,
that's
even
why
like,
that's why you had toilet repair like every Wednesday night.
150. Yeah, but like even if nothing looks wrong on the payout sheet that you should be receiving at least on a monthly basis for the rentals that you have, it's good to just question them to show them that you're paying attention still, and you're not just forgetting that you own these houses at some location that you looks like you don't care about.
Right.
Just keep them on their toes that you're serious and that you're paying attention to your business.
Do you still have weekly meetings with them, or do you just reach out when you have questions? Okay.
Yeah, I just reach out, and then when I drive into the area, I'll say, hey, I'm in town. Let's meet up for anything that you think is hot that we need to talk about. Or if you just want to go over properties, and the cool thing too is that if you know your property management and they're pretty good, they might even swing you deals on the side on top of that because they might know that you're going to use them for their property management. So It's like that can be a win-win, based off your relationship with the management company. And they're going to know other investors too that are offloading. So I got emails earlier this year about a big investor that was just trying to get rid of stuff, and they came to me. So I was like, hey, thank you.
Nice.
Yeah, I mean it's just to touch on the opposite side, or I guess it is kind of similar. We also definitely have a close relationship with the property manager on the commercial side. One bonus we have there is we have weekly meetings with them, so we get their attention that way, and we're able to keep up on the current happenings of the unit, whether it's vacancy, maintenance requests, renovations, make readies, any outstanding issues like that. So that is nice. We can hold them accountable that way. I would definitely say you'd have to pay attention to your property managers because, they are worried about keeping vacancy high, but sometimes not necessarily about the budget. You can send your maintenance guy to do infinite amount of things, or pick up supplies for things that may not need needed at the moment. So you do have to watch those. Because their interests are a little bit misaligned, but at the same time, they want you to do well too because they want to manage your future properties. But yeah, there is definitely a need to keep in touch with them, and like you said, Michael, question some of the things on a on the statement.
Yeah, I think too. I guess.
Right. Yeah, speaking of questioning things, I had a property manager call me about a toilet issue one month. Toilet, was backing up and not flushing. Okay, send out the plumber. Obviously, we want to get that fixed. So I followed up with them and said, hey, what happened with the toilet issue? And they said, oh, well, they went out and fixed it. Looks like the notes say they had to remove the toilet. They snaked the drain and now it works. I was like, well, that's not really good enough, guys. Is it my problem? Is the main drain backing up? Like, what's going on? Or was something flushed down like you could imagine a tenant might do? So I had to push back on them for a while, never got an answer. And then the next month, they told me about another plumbing issue where like the sink wasn't draining. So again, I had to kind of follow up with them and say, what's going on? What was the cause of it? If you send out a vendor, they better be damn sure to know like what is happening, what is causing this, because I want to know if I'm looking at $100 or if I need to budget for a, whatever, a $6,000 sewer replacement. So I think it's just like Michael said, it's good to be on them, question them, read the budgets, read the statements, just so you're aware of what's going on with your business.
Definitely.
Right. Yeah.
I think that's it. It is similar. As far as managing the units yourself, if you can't afford or don't have enough doors to pay for a management team, the bonus is you have 100% control. So I've done that on my own rentals. Um, done the management, the repairs, take the leasing, taking the calls. So the only downside of that is it sucks your life away. So that's why we all move
Sounds
to
great.
the management side. And there definitely could be an argument of the 8 to 10% that you would pay for the smaller scale stuff could be worth it. Especially if you buy it right. But what I've been seeing here is that management companies like to see 40 plus doors before they start giving you a break, which is another reason that it's always tough to scale as fast as you want if you're going to be buying duplexes and fourplexes and single families to get to that level without, gathering people up in a syndication type deal. So as far as management, you obviously will pay more with the single family versus the commercial side. The commercial side, you probably around 3 to 4%, starting from 50 doors and up. So that's a bonus there. Another thing for the management, which I think people just need to be aware of, is some people do flat like 10%, and then some people do like 8%, and then they charge you for doing the showings and sending maintenance people out there, management of repairs and renovations. So you do want to consider those extra nickel and dime fees when you're considering a management company.
Mhm.
So because those definitely add up.
Another way to keep the management at least motivated to maintain the low vacancy rate, you can have your contract written up where they don't get paid the management fee if it's not being rented out. So if you're not making money, then they're not making money. So
Right. Yeah, you want to align those incentives too, for sure.
Yeah.
And then let's see, last thing we could talk about for the night, the refinance part. So a lot of us had experience with running the properties through a renovation schedule, getting tenants in them, getting them rehabbed up, making them look all pretty. How's your refinancing going with your properties or what you've done in the past? Anyone could jump in.
Okay, I'll go first. I think for me, it's been pretty simple. Like the process of just getting a refinance is likely you need a appraisal done, or the bank needs to evaluate how much your rehab is going to be worth and boost your value of your home, and then you can refinance off of that new loan, and you can you'll get your appraisal value or your projected value of that property, but it's still up to you as an investor to decide how much you want to refinance out to raise that loan limit out to. I mean, everyone gets real excited about refinancing, but I also think you have to think 2 steps ahead. Like you're gonna have to think about your cash flow and how much your loan balance is gonna be. So sure, you can do that BRRRR strategy and make your cash flow near $0, but you're extremely leveraged along the way. So you have to find like that happy medium of, okay, I have less money out of the deal. That's a good way to grow in another property. But if there's gonna be any hiccups, I can still afford that extra savings along the way so I don't go south.
What refi rate are you hitting?
Like percentage wise?
Yeah,
80%
I
value,
got
80% RV. And I've always taken, well, not always, but I usually will take, or I'll try to take basically enough where it's paying myself back the initial investment, and I just keep the rest in the equity, and
Right.
then that's like a safety net, and then that's less of a loan that I'll have taken out, and then I'll try to pay that down, and then you know X amount of years I'll use that equity again to go and refinance and go buy more properties at the same time. Just got to find like that balance of what you're comfortable with doing.
And that's the key. You got to obviously have a path for the money to go to if you're going to refi versus just get your money out and have it sit in the bank.
Yeah, another cool thing too is like if you work with a bank that knows that you're going to do rehab on it, like you already tell them up front what your goals are, and you tell them what your rehab scope of work is and the level of quality, they can already kind of project what your ARV is going to be before you even do it. And that'll again help you crunch your numbers in advance before you even close on the deal. So I find that super helpful because you're not just kind of going blindly and rehabbing it and then getting some guy to walk through it and your numbers are off. And you're like, oh man, I spent too much on this deal.
How close were they on the ARVs?
I got them always higher than I wanted, which was really cool.
Nice.
So I appreciate that. So there's tricks to, I think, to boost your percepted ARV values. I can probably go into that another video, but I can basically tell them what I want my ARV to be. There's a process to it, but.
And hang on, Michael, let me say it for you. Click the subscribe button below, push the bell button to be notified when he posts that video.
There you go.
GrowthMindset channel.
Shameless plug.
Gotta have those plugs in there.
What's the YouTube video of that?
Yeah, that's true.
And it sounds like that was the goal of doing your type of investment. Obviously, some people just buy and hold. I mean, you're still buying and holding, but you decided to pull your money out. Like it depends what condition, because most of the stuff I bought, there really wasn't too much room for a refi because they're in pretty decent condition already.
Yeah, I mean I think that it goes back to like what are your goals and how much risk are you willing to take along the way. It's like obviously you buy something super crappy, a lot more risk involved. But you can mess with the refinance numbers and how much money
Right.
would deal to get it out. And then if you do like the numbers too, like you buy a property, rent it out, pay it down, versus and then you don't refinance. Then you do another scenario where you do refinance. Just make that Excel sheet of comparing the two. If you're willing to take the risk and leverage, you'll grow a lot faster. So it depends on how fast you want to grow and how much risk you want to take. I think if you're near retirement or you don't want to take much risk, then paying down the property is obviously a safer route, because if you're out of money, you can just refinance or pull like a equity line and pay for any funds that you need at the time.
Mm-hmm. Mm-hmm. And we were talking something similar about that too, because it's a similar strategy with the commercial side, where people usually try to do a 2 to 3 year refi on value add apartments. You'll go in there and try to renovate all the units and then force appreciate it that way. And then try to get an 80%. You'll try to do like a bridge loan into an agency debt loan with a lower rate and an 80%. And you're obviously trying to pull most to all your money out. It just depends on the type of refinance you do, but that's definitely the way to make your returns higher, because you're getting your money out to put in another deal. And the slight difference in commercial versus single too is that in around a 5-year time span, you'll try to sell it and try to get that extra bump from the sales price, where single family, you'll usually try to cash flow it through the years, because you necessarily might not have that forced appreciation. But in the last couple of years, also the single families have definitely bumped up because that the rising tide quote. But into the years, it'll be tougher to get that extra appreciation without the ability to force it like you do in the commercial. So that is something obviously to think about, and a difference there. But similar strategies as far as the refi pulling their money out to juice those gains.
Juice.
I think that pretty much wraps it up. If you guys have anything else you wanted to chat about, or obviously we can save that for another video. Michael, you could send it home.
Okay. Yeah, so that was our topic on real estate, just a real high level first conversation on what we have for experience in single family versus multifamily. We will be doing more videos, or at least we plan to, on more technical information on how to close on deals, what to look for in deals, you name it. If there's any specific topics that you would like us to go over that we may have missed, go ahead and leave a comment on the website or the forum or the email, however you guys want to reach us, and we can make that the next video. So thanks for watching, guys. It's a lot of fun. Catch you on the next one.
Thanks, everyone.
Nice.
Bye.
Bye.
See ya.